Hey, all you Mitchell homies, welcome back to Behind the Build with Scott and Devin. I'm Scott.
And I'm Devin, and he continues.
Loves it. We love it.
The homies, oh my God.
We promised t-shirts.
We did.
So you guys got to let us know if you've watched all the episodes. We have t-shirts in production, Mitchell Homie t-shirts.
That's right. We have a couple people that have watched every one, and we
That's
appreciate you watching, whoever you were. I don't know. I only knew your handle, but we appreciate it. I loved hearing that. You know, hearing that somebody's like, watch everyone, wait to see the next one. So we hope that you guys are finding this educational and that you're getting a lot out of it. And today's topic is
Mortgage 101.
Mortgage 101.
Yeah, so we're gonna tell you guys a lot about mortgage loans. We have a very special guest, Chris Cleveland with CrossCountry Mortgage. Chris is one of our favorite partner lenders, and he knows a lot about mortgage loans and everything to do with lending.
So today, I think we're just gonna try to get the story from you come in, you meet with the new home sales consultant, and then how that evolution happens through the lending process, right?
Yeah. We'll walk you guys right through the lending process from the pre-approval to the closing, and we've got a lot of really good information coming your way. It's one of those things, you know, you may not think about it when you're thinking about building a home. The home is the exciting part. The loan is really kind of the thing that makes you stress out a little bit.
Right.
But I think, you know, we want you to feel comfortable with it. We do get a lot of questions about loans and the different types of loans and whether or not you can roll your land payoff into the loan. So we're going to go over all that with you today. And I don't really know a whole lot about it. I know a little bit. Devin probably knows less than me. But
I don't know anything. No, I know a few things. I know a few things. So I know that there's a lot of questions. So I'll be able to ask a lot of questions today and learn as well.
Yeah.
So I'm excited to do that. I know Chris is very nervous. If you heard the rookie mistake that he just made, because we don't edit this, they are uncut. He coughed in the background. He doesn't know what he's doing back there. So we're excited to bring him in, and hopefully he's not too nervous so he doesn't get all gummed up and he can't talk. But we're excited to have him, and we're hopeful that you guys get a lot of information from this. And, you know, like we say all the time, these are unedited. They're unscripted. You know, we're going to try to ask the questions that you would want to ask so that, you know, especially from somebody like myself who doesn't know all the ins and outs of this and probably should. We hope that you're able to learn a ton from this and ask questions in the comments. You know, let us know.
Yeah, let's bring him in.
All right. Chris Cleveland, he's here in the flesh.
All right. Welcome, Chris.
Thank you.
It's good to have you.
Glad to be here.
You've been looking forward to this?
I have.
Good.
Very cool.
Good. Yeah. So, you know, we're going to kind of just rely on you and lean on you. But, you know, I think like maybe we'll take the customer through or take our potential customers through the whole journey from like, you know, when they come in and they meet with one of our new home sales consultants all the way through the end.
Yeah.
Yeah. You want to maybe kind
Sure.
of tell the audience a little bit about yourself?
Absolutely. First of all, thanks for having me on the podcast. I think I've watched all the episodes on XL.
You get a t-shirt.
Yeah. But anyways, thanks for having me. The podcasts are awesome. Not just saying that, I think they're a valuable resource. I know for a fact some of your clients have watched every one of them. I've gotten some really positive feedback. I have watched not every minute of them, but you know, there's stuff on these podcasts that I've learned that I didn't know about building. As you guys, some of you guys don't know some of the, you know, tougher lending stuff we go through. So again, thanks for having me on the podcast. I think it's a good thing. I've been in the mortgage business for a long time. I've worked with Mitchell. Scott, how
Long time.
I
I don't
was
know.
like
I'm not sure.
15.
It seems like it's been forever. Yeah.
It makes me feel old. But yeah, we've been working together for a long time. I'm not, you know, I'm a separate company from Mitchell Homes, which is more often than not, that's what you're going to find. And I think that's a better advantage. I've been in the mortgage business a long time. Our offices are coincidentally right down the street from each other. They used to not be that way. You know, we do CrossCountry Mortgage. We do mortgage lending, all kinds of mortgage lending. But our area of expertise, my area of expertise for many, many years has been new construction. Mm-hmm. So we know the hurdles, not just with, you know, what you guys have talked about on the podcast. We're going to help, you know, obviously guide customers probably back to you when they're talking about, easements and things of that nature. But, we understand the new construction, build on your own land product better than anybody. I mean, we really know it. It's our cup of tea. Whether you're buying the land, whether you already own the land, whether you're buying a spec, a spec home, which is, to be built. We know the different nuances in how to structure those loans. At the end of the day, you're going to end up with a standard mortgage loan more often than not, 97% of the time, which means, FHA, VA, conventional. We'll get into that. But, I've been doing mortgage lending with Mitchell Homes and some other builders, but mostly Mitchell Homes for 15 plus years. We've seen it all from subprime, which doesn't exist anymore, kind of coming back. And we maybe not want to talk about that, but to, construction to perm, if you need to buy land and build, and there are builders that require that period, even if you own the land. So we can get into that too. So that's a little about me. We've got a very good team that works on Mitchell Homes loans. It is a team effort. We want the service to be impeccable. We want questions to be answered right away. It is a nervous process to borrow $200, $300, $400, $500, $600,000. It's a lot of money. It's a big commitment for payment. We were joking about this before. The new car smell can wear off once they start talking to the mortgage lender, and we start talking about the numbers. So
Yeah.
that's my introduction. We can.
Yeah, no, that's great.
I'll put it back to you guys.
You made a point that I hadn't really thought about.
Yeah.
Is we have been working together for a long time, and you kind of specialize in new homes,
Correct.
right? So we at Mitchell Homes we have a couple preferred lenders. There's no affiliation.
Working on that.
Like you said, there's no affiliation between us. There's no
Yeah.
common ownership or
Right.
anything like that. But sometimes customers will come to us and they'll say, hey, can I use my lender? And you could talk a little bit about this, but
Sure.
I think a good point here. That's a good point because we have a relationship and you understand our business, and you're able to process those loans more efficiently, which then in turn leads to less problems, less delays, which can cost money.
Yeah, guaranteed. And we find that it's a common problem in the industry when a builder has a preferred lender. Look, sometimes the preferred lender is about money, and I mean I can attest that it's not with us. We're not. There's no money exchanging hands, and there are compliant ways to do that, but that's not something we do. It's more about your back end, the person that's your contract administrator, the person I deal with the most, this is where we're at, this is the issue we're having on this, and this is when we need to get this loan closed. These people want to move into the house. It's almost done, So the snag you get is that, and nothing against the other lenders out there and anybody on this podcast that's like, well, I've worked with this lender for a long time. If they are unfamiliar with build on your own lot types of transactions, that can be problematic. Mm-hmm. And I've seen time and time again where a lender has come to you guys and they've really put the foot down, the customer, and said, look, I really want to deal with my lender. And they don't understand that we're structuring this as a refinance and we're paying this off. And, we've got the well and septic separated out, so on and so forth.
Right.
It's complicated, not overly complicated for the buyer that's on this podcast to worry about. It's more about getting it through underwriting without having to reinvent the wheel.
Right.
And that's really what it's about. It's about the customer service aspect, and our rates are killer. They really are. So we're very competitive on rates, and we get into rates because today's a big day. Rates.
Well,
a big day.
I want to ask questions too, because while we're on the subject, and I know we want to go through more of a timeline, but
Sure.
To the people that have their own lenders, what I find just from my seat, where I'm sitting in meetings on Tuesdays and we're trying to estimate closing dates, and we're kind of clunking along with the construction and things are moving, and we have an in-house person who handles and works directly with you. Her name is Janet, and she handles all of the mortgage. She's the liaison between the mortgage lender and us. So she deals with that all the time, and we get to the end, and they haven't gotten the paperwork that they need, they're unresponsive, and here we're ready to close, and they don't even have their loan totally fulfilled yet, and we're scrambling at the last hour. And, not that we ever want to do this, but just to say it so we can kind of complete the circle here.
Right.
If we get to the end of a job, we've talked about it on multiple podcasts. We have price lock. We have a 150-day guarantee.
Yeah.
We're going to close your house as quickly as we can. It's our money. We've said all this. But if we can't close, you go on $200 a day, and it's in our contract. And it's an uncomfortable conversation. But if it's something that you're holding up the closing for, there's a penalty to that. So sometimes when you go with your own lender who doesn't know how to navigate those waters of on your lot, there can be a repercussion that, of course, the lender who doesn't work with us at all and doesn't know us and so on and so forth, they're unfamiliar with it anyway.
Right.
So they get, gummed up and things just kind of start to creep. So, I want to make sure and say the why we preferred you go with one of our preferred lenders, because they know our business, they know how we work, they know us,
Yes.
they know Janet,
Right.
and we can get things closed up and buttoned up for you guys much more efficiently. When you talked about efficiency, that's where that efficiency happens, because it does go quick. The next thing you know, we've broken ground, and the next thing you know, you're looking to close, and if we don't have a partner that's working with us on there, pretty soon you're
Yeah.
going to close and
It's not ready. And if we had Janet in here, she would say 10 out of 10 times that a customer doesn't use one of our preferred lenders, there are delays. And those delays can be significant.
that's right.
It may be costly. Yep.
Yeah.
And it's just so we understand that those of you out there, how the impact is for you specifically. So,
Right.
Yeah.
Not to belabor
Yeah.
that.
Yeah. Well, no, Janet is, you guys a little bit, but Janet and I want to stay on her good side. I mean, that's, I talk with her every day, and she worked at a mortgage company. So she knows, like, I can say, look, here's what we got going on, and we can work it out. And a little bit to your point is the timeline is also very concerning. And when it's outside of us, because we are constantly having pipeline reviews with Janet. She is inundated with pipeline reviews, not just with you guys, but with us, because we want, when we're like, we're moving this one up, we're moving this one back. We never want to be the cause of the delay.
Right.
Right. We never want to say we're not ready. Yeah. We're going to let everyone know if, like, look, we're waiting for some documentation from the customer. But, I've had conversation after conversation with Janet where she's pulling her hair out because the other lender is just, you all do a very good job of I think informing your customers too, but I don't really see as much of that, but informing us of where you're at on each project. If there's a delay, we're trying to solve this problem. I get it, and I tell my people, look, guys, it'll close when the house is ready. And our job is to, have the financing in place when you guys are ready to pull the trigger. Now, the tricky part about that is things can expire. Right. So we gotta be ready, but that's okay. It's like, okay, give us an updated pay stub, put it in the file. So we have a lot of flexibility, and we've also, have a lot of exceptions because of the relationship. I mean, we're the largest retail lender in the country right now. We lend like $4 billion a month. It's astounding. But higher up in my company, I have had conversations where, like, this builder provides us X, Y, and Z. We need exceptions on these things, and we have all these exceptions in place. I don't know if we need to get into them, but they're substantial, and they help things go smoother with someone getting a loan. Right. So
what happens? Let's start in the timeline.
Start at the
Right.
beginning. Yeah. And you kind of
it's grueling, just so everyone knows.
Yeah. But so if somebody comes in, right? Yeah. Like, they come in, they meet with one of our new home sales consultants, they sign a contract, or before they sign the contract,
Usually, yep.
they reach out to you or somebody that works at CrossCountry. And what happens?
Okay. So it's a mix, of the exact timeline, but we'll stay general. Usually at initial meeting, maybe second meeting, maybe third meeting, phone call, I don't know, between the sales agent at Mitchell, who we have excellent relationships with every one of them. Mm-hmm. They are filling out your sheet. We also have an online application, either or.
That's the pre-approval application?
Yes, this is pre-approval. I'm sorry.
Okay.
Let me be clear. I'm sorry. So yeah, and then we got to get like some semantics here. Pre-approval, right? So and really that technically should be called pre-qualification, but again, for anybody, that means that we're going to issue you're pre-approved for X loan amount, for whatever program we decide, when we'll give you the options. And it's very, I hate to say it's kind of generic. It is not tied to Mitchell Homes, which we can't do legally. So it's a pre-approval for a mortgage loan, and that's what we're shooting for. But before that occurs, a lot of times, a lot of your sales agents are kind of, we have one with Gary, he just goes down the list. If he doesn't get somebody, one of my lenders is picking up. If the customer's sitting right there and they have questions, we're going to answer the questions right there and then. And then a lot of times the pre-approval is going to come over, just some very, I don't want to say basic, but we're just getting a broad picture of your financial situation. Mortgage 101, just to get a mortgage, you need 4 things generally. We need income, ability to repay. Those are synonymous. Credit, also your history of repayment. Collateral, usually not an issue there. It's a brand new house. We're happy with the collateral. Sometimes they can get funky. But we cross that bridge when we get to it. And then a fourth and maybe an intangible with you guys is liquid assets, because a lot of times, and this is something we'll get into later, lot value is considered, it's not liquid, but it is considered an asset, and it will lower your loan to value, which is key. So we're using lot value as down payment, So
Right.
Generally you need some kind of down payment. Not always. There are programs that have 0 down payment, but if you have lot and you have lot equity, that can be considered part of your liquid assets. If you're buying a lot, we're verifying assets. So you need those 4 things. So we're looking at those 4 things. We're kind of taking your word for it up front to issue initial pre-qualification. Sometimes it's pretty cookie cutter. I've worked at here for 20 years. I make this, and this is what we're going to buy, and I own a piece of land that's $100,000, it's free and clear, and I have an 800 credit score.
So this is all non-verified at this point.
Credit is
verified.
Income is only verified if you're self-employed. Sorry, self-employed people, things get complicated. We want to take a look at your tax returns, and that's something that most self-employed people are used to.
Mm-hmm.
Right. So that once we do that, we issue a letter to the salesperson. The loan, usually at that point, at some time, if you're going under contract. Once you're under contract, the mortgage rules are pretty strict to enter into an official loan application. I need that. You're under contract. We push you forward to a full loan application. More income is verified. We get you through underwriting. We order an appraisal. The appraisal comes back fine. We get you an approval. Mitchell builds. Once the house is done, we redo everything, but the loan sits in a kind of I don't want to say not suspended, that's the wrong word, but it's in a dormant status. It's still there, but everything we verified is expired, except for the appraisal. Appraisal's good for a year. We come back to you and say, hey, great, good news, your house is about to close. Let's get your rate locked in. We'll talk about that, how it's advantageous not to lock rates now, but to lock at the end. We re-put you through underwriting. The good news there is, assuming you didn't go out and buy a Ferrari or anything like that, which we highly discourage, do not do anything major financial moves during the build. We put you back through underwriting, get you cleared up, get you closed. That's it. It's that simple.
All right.
That's it.
No.
Now there's 1,679 things that could go wrong during that, and they do happen.
Well,
and life happens, and we deal with it. And strange situations occur, and we've seen them all, and we get through them. And you told me this years ago. Even some marginal credit people, we find a way. I don't want to hit this one too hard, but if we have a snag, we work it out, and we're gonna find a way to get the mortgage done, because that house is under construction. Look, guys, Mitchell's taking a tremendous risk. I have no other builder that does this. I am not taking any risk. I'm just giving you an approval. If everything goes south between now and then, I cancel the loan application.
Right.
Mitchell puts a lien on the property. Every other builder I have is going to require, I don't care if you got a 300,000 piece of land free and clear, they're going to require a construction loan. I would assume all the risk. The Mitchell is going to put a lien on the property based on my upfront approval for you guys, and then close, and it has a bunch of financial advantages doing it that way for the customer. And then, Mitchell wants to close, they don't care if you pay cash. And that happens sometimes when we say, hey, I don't need you anymore. I'm like,
Right.
okay, well, more power to you. But that's a big deal. So we've got to make sure we've got a pretty solid, approval up front. And if something happens during construction, or we've got something that's a little marginal, we're going to find a solution.
Right.
And sometimes we're going to take a calculated risk.
Yeah, you guys typically do find a solution, which is
Yeah.
why we've loved working with you, and we love working with you. But there's a lot to
I mean,
dive
yapping-
in.
I yapping
a
too
lot
much.
to dive into.
I mean,
Yeah.
So
Yeah.
one of the things that
thought I
need
would have
to-
done.
No, sorry. I'm going to slow you down a little bit. So,
Okay.
Chris is talking from a position of power. He knows all this stuff, so it just kind of comes out. I'm going to
Yeah, I talk too fast.
I'm going to try to slow Chris down. So going back to the original pre-qual, they come in, they do the pre-qualification with the sales consultant, and we send that out. And pretty quickly, I would say between what's the time? 48 hours? 12
How long
hours?
does it typically take?
Come on. Same day.
Same day. So
We
we're
pride
getting
ourselves
that,
on that.
We're getting that pre-qual the same day. Why is that important? So, kind of you need that pre-qualification in
French.
order to in order to know your budget for the purchase of the home that you want to buy.
Right.
So without that, it's taking a break from the mortgage sides, right? So why that's critical is because we can't move much more beyond that point in how you would select a home. So I know we get sometimes people will be like, oh, I don't want to fill that out. I don't want to fill this out. And there's some reservation, right, about doing a pre-qual. And really all it is, as Chris has alluded to, it's just a simple generic form that allows us to help you make a selection of the home you want to purchase.
Right.
So at the very elemental basic level, this is where it starts.
Yep.
Right? So we get the pre-qual. That's from Chris Cleveland or whoever our partner lender is. And then we're able to make certain decisions based off that pre-qual.
Yeah, that's going to come in. It's going to tell us, okay, John and Jane Smith qualify for $500,000. So from that point, we know we can kind of back into, all right, we know we're going to need $30,000 for well and septic. We're going to need, say, $20,000 for site work. So there's $50,000. So we have $450,000 left. If there's nothing else to pay off, we have $450,000 for the model, the elevation, and the upgrades that go into that home.
So when we talk about mortgages 101, that's the start point on our end.
Correct.
Yeah, the customer may be prepping for this for many months and getting themselves in line. Maybe they know where they are, but the reality is when you sit with us and you've made the decision, which I'm sure you're going to go with Mitchell Homes, this is where it starts from a finance standpoint.
That's right.
And then, once we get to that pre-qual, what's the next step in your camp? What happens, so let's just try to do this hypothetically, right?
They've signed a contract.
They signed a
now.
contract, they've made the decision on their home, and all the other things that we've talked in other podcasts, those go on. So we don't have to dredge that up.
Stuff happens simultaneously. Yep.
But from a mortgage standpoint, after they've made their decision on the home, they've went under agreement, what's the next step from a mortgage perspective, and what kind of interaction do you have with the customer directly at that point?
Well, it's a good question, and they blend together. So and again, I went super fast over the whole process, and we can dive into each one of those little sections. The pre-qual to full loan application is a very important time for the interaction between the customer and myself and or my loan officers, whoever. So you bring up other preferred lenders. I prefer that we didn't do that any longer. But, so just kidding. So, that's when we're really digging in. We're digging into the numbers. We're talking payment. What if rates do this? What if I go to here? What can I afford this? It's not just about the pre-qualification. It's not just saying, here you go, $500,000. The reality of the payment comes in, and rates are dropping, guys. And the good news is, I think we went from unaffordability back to affordability. I believe that is really coming. People I pre-qualified in June, they've got $300 or $400, depending on how much it was, $300 or $400 better payments today. Talking to them, so we'll get into that. But we're really digging in, not just max. And a lot of times, look, if you easily pre-qualify for something. We're not ever going to try to push a pre-qualification up to increase a sale, to have a higher loan amount, a higher purchase. we do it more for comfortable, to be comfortable that, look, if things go up, things inevitably do go up. You add things, whatever it may be, whatever pops up. We always want to be at the highest possible pre-qualification. On the same token, we hear from customers all the time, like, I am not exceeding this loan amount. Okay. And that's fine. That's between you and the builder at that loan amount, at this pay rate, this loan program, whichever is the best loan program for you. This is what you're looking at as far as your payment's concerned. So those things are all dug in. And then back to your question, once the contract comes in, another very detailed conversation is had between us and the customer, really honing in on what you want that mortgage to look like. Because we are going to then disclose the loan to you. And it's all done electronic. Everything's electronic these days. It doesn't have to be, but I can't remember the last time we done. So it's all online. It's, we have a portal. It's a very easy, user-friendly portal where you can upload documents, and I can send you documents to eSign. So that is done once within a few days of the contract coming in.
You're getting that portal. They're getting a link to a portal.
Correct.
Where you have all of the loan disclosures, which is all the legal jargon, correct, about the loan.
Yes. Loan estimate, very important document. Yes.
Okay. So they're going to e-sign all of those. And then do you also at this point have a checklist of items that you need from them at that
100%.
point? Okay.
And a lot of times, guys, we're trying to be proactive, and there's nothing wrong with sending those in early. There's nothing wrong with that. You can upload, we can set up the portal at any time. In fact, and that's why I'm pushing this a little bit, but if they do the online application, the portal is set up, your portal's set up. So you're able to log in and look at documents anytime you want and upload documents anytime you want. I got a new pay stub, download it as a PDF. It's just a click, and it's very secure, and those documents are uploaded.
So on the portal, I'm trying to take the buyer through. Like, so we've come in, they've picked us, they did the pre-qual, they've got the pre-qual. Now they're at the actual mortgage application within a few days of agreement. And when they get the portal link, is there a list of stuff that they would need that it's easy for them to see? Like,
100%.
I need
it's buckets.
W-2, I need
I'm sorry, I meant to answer your question. Yeah. That list, again, we either send it out early or at application, because sometimes they're not doing the online link until right, which is common. No big deal. And it'll be in an email. Of list of documents that are needed, and then when you go into your portal, it'll remind you, and almost to the point where it gets annoying, where it sends too many automated reminders, like, "Hey, we need your pay stub," but you just drag it right into the bucket.
Okay.
Yeah.
So what? Give us
file cabinets are dead. I have tons of empty file cabinets. If anybody wants one,
we got some.
Right. Exactly.
Yeah. What? Tip? Like, just I know this can vary based off of. The buyer, but what are you typically requiring of them to upload? Because people say,
a list of documents.
Like, I'm not. This is way too much. Like they want my blood.
Well, we are lending you $500,000. Yeah. So So the mortgage process still is a little intrusive. I admit it. We do ask for too much sometimes, in my opinion. I'll send this to one of my underwriters. But a standard documentation is, a couple pay stubs, your W-2s, a couple months of bank statements, and then a slew of miscellaneous stuff, depending on your current financial situation. Do you own another house? They're like, well, why do you need the homeowner's insurance on the house that has nothing to do with it? We need it.
Right.
It. We're looking at the premium. We don't care if it's insured or not. We've got to. I mean, it's just, we know from experience. I mean, I don't want to bring it up, but like myself included, like, you have this small company, we're going to find everything, fortunately, unfortunately, we live in an age where we were talking about this before the podcast, that you can almost see everything about an individual. And if there's other properties we don't know about, we need to document those. So the list is specific usually to the transaction. But
Okay.
generally, we need to verify your income. We need to verify your assets. Those are the two biggies. We already have your credit. And then remember the four things: assets, income, credit. We already have that. And then collateral. And we'll get to that. That's coming down the road. We're going to get an appraisal.
So it can change based off of the application. So what I'm hearing is, so the customer does the initial mortgage application. You guys review it. Based on the review, you may ask for 1 or 2 or 3 or 4 more additional pieces of information outside of, like, if they owned another home. Not everybody's going to have that situation, or whatever the case is. So it evolves
As you discover things.
as you go through discovery.
We want to, well, I didn't mean to misspeak. We want to discover everything up front at pre-qualification. We want to, so the application that is in the system, it's called a 1003. It's been like this for 100 years, is my loan officer should go through that in detail. Do you own any other properties? What is, if we have an account that we're a little questioning on your credit, we're gonna dig into things like that. Those are other documentation examples that we may ask for. Can you show us proof that this has been paid off? So on and so forth. It's really highly, and this is where we get a little bit into, I have great credit, why are you asking for this? So bear with us, please. And you can always call me and I can see what I can do. And there's sometimes, frankly, I could say, you're right. The underwriter's going a little overboard on this. And fight for an exception.
But generally, you're not asking for anything different than any other lender. Lenders are going to ask for the same thing regardless of who the lender is, if they're doing their job correctly.
Correct. And to a CCM's credit, we underwrite to Fannie and Freddie. We pride ourselves on not having overlays on standard documentation, standard loan programs. So, everything's automated these days. The automated underwriting approval is going to kind of condition us. We call them conditions, underwriting stipulations, so on and so forth. If we see something on there that the automated system is asking for, we're going to ask for that. And that's all we ask for.
You mentioned overlays. What's an overlay?
An overlay is where your big three: conventional Fannie Mae, Freddie Mac, FHA, Federal Housing Administration, VA, Veterans Administration. There's your big three loans. They've got, I forget the percentage of loans that are done in the country, but it's pretty darn big. That's what they are. Whatever their guidelines are, we underwrite to their guidelines. We don't add additional layers of risk requirements that are not on their guidelines.
Okay.
Some of your stuffy banks, they do that. Sorry, stuffy banks, but you do. So, and we don't. We're a residential lender. We lend direct, which means, we can follow the guidelines as they're written.
Right.
Yeah. But
I have a question.
Yeah.
So the online application, is there support for folks who need help filling
100%,
that out?
100%.
So there's a resource for them to go, whether it's an online manager or however you do it. There's someone there to help assist if there's
Usually us, but if I gotta get the tech guys involved, and if you're not technology friendly, I think we just had one of yours. The guy was coming by every day. He was a great guy, and just dropping off stuff old school. That's fine. We'll figure it out, guys. It's this, the online portal speeds things up, but there's still the possibility of going and printing out a loan package and doing a wet sign.
Okay.
Yeah, no problem.
So they get the application in that and it sounds to me like it's pretty straightforward. So application goes in, again, trying to create a timeline with how we build, right? All the other stuff that we've talked about in the podcast is already happening.
Right. We're drawing plans.
Yeah, we're going forward.
Yeah. Working on selections.
That's right.
Doing all that stuff.
So what then after that application comes back, what's another milestone that the customer should be paying attention to?
Good question, and a big one is title, and we order Janet orders. We're looking at title. Title's a big deal. You want to make sure you have a clear title. There's no issues. There's no liens you didn't know about. Family land can get tricky, as we all know. I defer back to you guys if we're like, we got a little title issue on this. We got a angry neighbor with an easement issue, whatever it may be. A lot of this stuff is not my area of expertise, I'm going to defer back to the title company and the attorneys. It doesn't matter to us as long as we've got clear title and our lien, just like you guys care that you can build and put your lien on there.
Right.
It's actually really nice because you guys are very interested in title. So it helps me tremendously. Janet helps me tremendously to analyze the title and say, look, do we have any kind of stuff going on? So just go ahead.
Anything that could potentially come up that would prevent it from closing.
Correct. And that's if there's errors, what other problems do we run into? Landlocked. We've seen it all. Right. And these are things that can be solved. But we may have talking to attorneys and things like that, and a lot of times the customers are well aware of it. I'm like, we're working on it. And I'm not going to prevent that from slowing down your approval. And I would defer to you and Janet. And, sometimes, frankly, we'd be like, we've got to pump the brakes and solve this title issue before we can really spend a ton of money and move forward.
Right.
So there's that. The other thing is you mentioned plans. We're waiting on you guys for plans. And it's a happy day when I get the email from Janet and she says, here's the plans ready for appraisal on this one.
Right.
We love it.
Yeah.
Because then we know this thing is really coming together.
Right.
You know what I mean? So it's like, cool. We get to see the house on paper. We're going to appraise the house. Am I going too fast? We're going to appraise.
I'll slow you down.
I know.
I'll probably come back. So you just go. You go ahead.
Because I could. All right.
No, I mean, I guess
I'm talking next step. But you want me to go in appraisals?
No.
Because that's the next step.
Right. So you just trying to create a very clear time stamp for those that are listening.
We have a document too that spells all this out too. So.
Perfect.
Yeah.
I mean, it's just we got we go back through it. So now we have the clear title after that application, and again it sounds like we're drawing plans. We know that title's clear. Let's assume that all is well. There can be title issues. I don't know, maybe is there a way for customers to check their title, any title issues prior
and they
to?
do a title search. You can pay for a
You
title
could do
search.
your own title search.
I didn't know that.
Yeah,
It's a
but
genuine question.
it's something that's included. It's something that we do for everybody. So
Yeah.
we're going to order that title search.
But if someone were curious,
they
have a piece of property that maybe's been in the family for 4 generations.
Yeah.
And
My Uncle Earl gave a sign off.
They have it.
Yes.
And there's 17 cousins attached to the title.
And 3 of
That's
them.
happened.
We got one of those.
Well, the problem is when they're dead.
Yeah.
That's
Or
right,
in
when they
prison.
pass away.
They run into that.
Yeah.
So it was more of a general question, like maybe they
Or
could
nobody's
do-
heard from him for years, and they're like,
Yeah.
Right.
sometimes we get around it, but it's the attorney at the title company,
Right.
That's going to make the call.
Right.
Yeah.
Right.
That's a good question. I mean, to your point, and then I'll shut up. But you
You're the guest, buddy.
what does that have special privilege?
Yeah, you can talk all you want. That's what we're saying.
A lot of people know already that, look, we've got the land, and sometimes they're still working on transferring it. And I mean, it's that far away. So I don't know. Do you guys do plans when I don't know. Sometimes I think you do. Sometimes it may make a judgment call. I'm not sure.
Tucker, what do you think?
Yeah.
So pay attention.
She wasn't even paying attention. It's all right, Tucker.
It's so boring.
We're gonna get you a microphone next time.
As I'm doing this podcast, I'm like realizing how boring my life is. And I still love this stuff.
Very important.
Everybody just like glazes over.
Tucker's on her phone. What are you looking at?
I was texting my doctor.
All right.
Working.
No. So
I think Janet makes a judgment
it
call.
really is a judgment
Yeah.
call. It just depends on how serious of an issue it may be.
Or somebody makes a
but,
judgment
we want to move things along as quickly as possible to try to beat the
Right.
the 150-day pre-construction timeline. So unless it's something that we're concerned it can't get resolved,
Sure.
then we're going to move things forward.
Yeah.
We do have checks and balances for those that know. We have different what we call ready to draw stages.
Right.
Yeah.
And if Janet gets to a place in the final plan stage and she doesn't have what she needs, we will pause it there.
Sure.
So we have a mechanism internally that will slow things down if we don't have resolution to something, or if she has a heightened awareness to something that could be a potential problem. We definitely try to throttle the brakes.
As you should. Yeah.
So you get the titles clear, all's well, and now we're talking about we've gotten the plans drawn, and those go to you for an appraisal. And I know this one is something we want to take our time and articulate well to the customers, because this is one thing I hear, I can't believe it didn't appraise for more, what's going on? And we get
Yep.
I hear that not often, but when I hear it, it's loud.
Yeah.
Let's say that.
Who's that?
Just the people that are
You
frustrated.
talking about Janet?
No. Well, she's loud, yeah. But I'm talking about the customers get frustrated that there's what we call a bad appraisal.
Yes.
So let's talk about appraisal and what that is.
A low appraisal.
A low appraisal.
Yes.
Did I say high?
You said bad.
Maybe I
Appraisals.
did. So a low appraisal, I apologize. Carry on.
So during the mortgage process, I have control, or we collectively can analyze and see and quantify the other three things I said, which were what?
Don't ask me.
Okay.
You're the guest.
Income, credit, assets. Simple. Those are documents, right? Income can get a little funky if you're self-employed, but we'll figure that out, right? So we can look at those things. The appraisal's the big crapshoot. It is ordered compliantly, legally, through an independent agency, an independent employed appraiser. VA has their own system of ordering appraisals. We get plans and specs from Mitchell. Now, knock on wood, I think this is wood. I haven't had that complaint in a while, and that's just because I think we're moving into a hot market with the rates and everything. So, we are taking a look at a house that is hypothetical, that exists on paper, and the appraiser, are going to appraise it based on 3 to 6 comparable houses that have sold within a close proximity, within a close time frame of the house we're building, right? And those comparables are really going to be what's going to give us our best guess of what the value of the house is.
And that's important. Why? To the customer.
Well, it's important to everyone. I mean,
Okay.
that's the collateral. I want to say it's the most important thing, but it is up there,
Right.
And we as a lender are not going to lend you more than the value of your house, land and house combined. It's just not going to happen. We used to do that. There were 125% mortgages. Do you remember those? Then 08 happened.
Yeah.
So you wonder why. But anyways, it's important. If we have a transaction that's tight, and what that means is you bought $100,000 piece of land and you owe $100,000, right? And then you're building a $450,000 custom.
Mm-hmm.
We're concerned, and it's in the middle of nowhere. Where's the comps? So you got a $100,000 piece of land, and you're building I don't want to say generic, but a standard house plan. Better way to say that. It's going to sail. So on appraisals, high customization, very expensive options. What other things? Weird, better than me.
Yeah.
Weird things, not weird, but cool things. They don't always appraise.
That's right.
You don't want to be the best house in your area, unfortunately, or you do, but
Yeah.
Yeah.
The other thing I think
Right.
that can trip us up on the appraisal
Right.
is a very expensive septic system,
thank you.
right?
Yeah.
If there's a ton of site work that needs to be done,
Yeah.
like you've got $30,000 in clearing and you have,
And I should have brought those up.
things like that, you're not getting any value for that stuff.
Right,
You're
right.
getting no value for a septic, right? You're
Yeah.
getting no value for a well.
And I agree. I didn't mean to be too disparaging about custom stuff, custom houses, moving roof lines and stuff like that. That's killer.
Oh no,
I
yeah,
love that kind
yeah.
of stuff. But
it can be a problem.
right, and listen, and to your point, a house that appraises down the street with a standard septic is what, 15, 20 grand?
Somewhere there, yeah.
Right, somewhere.
Yeah.
And now, unfortunately, you've got a $50,000. The appraiser's not going to increase your value by that.
No.
You're not getting the value of that more expensive septic system, unfortunately.
Right.
And again,
And that's assuming that the customer is rolling that into the mortgage.
Right.
The septic, the clearing.
That's right.
I want to make sure we're clear. So there's this out-of-pocket expense for certain services, right? So it could be, it's septic. Sometimes customers choose
Right.
to pay cash for those.
Right.
Lot prep, what we've talked about in other
Yeah.
podcasts. Sometimes customers choose to pay cash for that.
Right.
Which then negates. I just want to make sure we're talking.
Yeah,
about, so it does. If you're trying to roll it into the loan, it's got to appraise,
If it's in the loan, it has to be part of it, right?
or you got to bring cash.
Yeah.
or you got to bring it.
Right.
And that's that's a great point, because a lot of times we'll see something that's a little short, and Janet sends me an email a lot, like, what's your max? What's my max? What's my max? And I would say, okay, most of the time, as long as it's not the debt ratio, the customer or the loan limits, which we can talk about, that are set in the county per loan program. We'll talk to a customer and we'll say, look, we're thinking about, bringing that to the table anyways. And you guys are very cool about it. And you say, okay, great, just pay the well and septic bill when they come due, instead of having to bring the money, as most builders would do, before they break ground.
Right.
So there's ways around. Now, that's not always the case. If we're short, we may need the money up front, but that's a judgment call, right? When you say, yeah. So
judgment call.
Yeah. And again, we haven't seen it too much lately.
Well, we should not. I don't want to gloss over that really quick. So one of the decisions I make and Scott makes together, it's either him or I.
Yeah.
To be fair.
Yeah.
There's nobody else in our organization that will make these decisions. But if there's a certain amount over your loan amount that you're due to pay, and some people decide, hey, look, I don't care about the appraisal. I have $450,000 max loan, and I'm building a $600,000 house because that's what I want. I have the cash to make up the difference.
Right.
We require that at the pre-construction meeting.
Yeah.
So the pre-construction meeting happens. You got to bring that check with you to the pre-construction meeting to make, just for the difference, not obviously for the whole house, but to make up the difference. And when we talk about that, if someone's $5,000 over or $4,000 over, and they've got some things going on in their life where, hey, I'm going to have this to you by drywall, or we're pretty flexible, but the flexibility changes as our risk goes up. So I'm more flexible and Scott's more flexible. As if it's 150,000, our risk is high. So we're going to ask for a majority of that up front.
Most builders do.
And so just so everybody understands, just because you have a max loan of $400,000 or $300,000 and you have cash to bring, it doesn't mean you can't build with us, right?
Right. That's right.
There is that ability to pay cash, and a lot of people actually do that.
Yeah. Yeah. And this is really the only time with our Simply Mitchell that a down payment comes into play, as if it's,
it's not even really a down payment. It's a shortage.
It's a shortage.
Right. It's not a requirement.
That's
for the loan. It's
yes.
Yeah.
Yeah.
It's not a loan percentage requirement. Yeah.
Right. So for all those out there, when we talk about needing to bring funds to a pre-construction meeting, that is the only reason. Is if you're short on your loan and you've wanted luxury options that you want and you have the money to pay for them, we just require that earnest money before we start. Yeah. And that usually is at pre-construction meeting. But again, we're flexible sometimes in those. I don't want to represent that we're not. We do have flexibility, but it's a case-by-case basis, and there's a lot of nuance that goes along with that, because we do a risk assessment on that. Because, of course, if you don't come due and we don't have the money and we have
a big problem,
$600,000 house that you can't settle on, then we have the house, and we don't really want that. So we don't put ourselves in that position.
But I can't remember the last time I saw that. So it's,
At any rate, so we have the appraisals.
Yeah. And more often than not, one last thing on that, what I'm seeing with your also, pre-qualification and approval, one of the biggest snags is you got a house to sell. You have an exit property,
right?
What are you going to do with the house you're in now? Do you have a mortgage on the house you're in now? Well, we're going to sell. Okay. When are you going to sell? And I should have brought this up back, but one thing leads to another. Is your approval, pre-approval, full approval, doesn't matter, contingent or non-contingent, right? If I can give you a non-contingent approval, that means that, non-contingent can mean a bunch of different things, but usually we're talking about the sale of your current house. That means the lender does not care what you do with your current house. You could rent it, turn it into an Airbnb, whatever you want. You are pre-approved, non-contingent. You don't have to do anything. Unfortunately, if I say the approval is contingent on the sale of your current house, I'm sorry, Mr. Customer, I cannot qualify you with carrying both houses at the same time. Well, I'm going to sell. Okay, when are you going to sell? You're going to sell. I'm going to sell right before I move into my Mitchell house. That's another thing that I'm coming to you guys and saying, here's the deal. here's the deal. And I don't know if we want to go down this road, but
Yeah.
I'm going. So look,
get-
if I go to you guys and I'm like, look, this customer's super solid. Here's what the house is worth. $500,000. They owe 200. It's going to sell like hotcakes. If they don't get what they want, they drop the price and it sells for 2 seconds.
Right.
You guys have in the past made some judgment calls there.
We have.
If it's borderline and we look at the property and the house to sell and, you got horses walking through your kitchen,
Yeah.
it could be problematic.
Right.
So
We definitely take a look at those. And
Yeah.
again, that's Scott and I make.
nobody wants to
those-
move twice. I get it. Go put your stuff in storage. Sorry to interrupt, but
No,
go
yeah.
ahead. Yeah.
We try to be flexible. I mean,
Yeah.
we really do in that case. I mean, I know those come across my desk quite frequently when
Yeah.
that happens, and we'll take a look at how much equity do you have, what's the difference, what the contingency is like. There's a couple though. So, and I'm no expert. I just know what I see. So there's one that they can't carry both house payments. So it's contingent on the sale of the home, but the proceeds don't matter as much as just selling the house.
You're correct. Yeah.
Now, then there's also
Could be both.
could be both. There's also maybe a debt issue that has to be satisfied prior to full approval. And the way to satisfy the debt issue is to sell the house in order to satisfy the debt issue in order to qualify for the loan. I know that sounds super complicated, but it is important, when you get your...
Mortgages a lot better than you let on.
You actually just surprised me.
I am
Was that something?
stupid smart. No.
How'd you know that?
I just, because I listen to the meetings, but I want to make sure we delineate that. So,
Yeah.
because there is a difference,
Right.
especially more on how we evaluate it.
Sure.
My risk issue, if you have a home to sell, and we have that a lot, right?
A lot.
So people have a house to sell, which is totally understandable. You're
Right, of
already
course.
living somewhere.
Right.
So you have a house to sell. You're buying this house. The contingency, Chris says to Janet. Janet says to Deven, the contingency is that they sell their house. And that's it. So they can't carry 2 mortgages.
Yep.
So,
Right.
okay, cool, good. What's the house worth? We look it up. We figure it out. They owe $100,000 and it looks like it could sell for $5,000.
Right.
I'm fine.
Yeah.
Because especially if it's the proceeds from the sale of your home
Right.
don't need to come to us. You can do with them what you want. You
I
can
didn't
do
know
with
that.
it whatever
Okay.
you want.
See, I'm learning
Right.
something.
Right.
So it has nothing to do with anything
Yeah.
other than you can't carry 2 mortgages. So, and you have a good equity position in your home. We're going to work with you to try to minimize your discomfort on how often you move.
Yeah.
So we really would rather work with you if we feel like very confident in the situation.
Right.
Because we want it to be as easy for you as we can make it. I don't want
Yeah.
to force you out, have to do a rent back, have to live in an apartment,
Yeah.
have to do all this jostling.
I don't know a lot of other builders that are doing this.
We really try because I know how
that-
challenging it is.
I don't know that there are any other
Yeah,
builders that'll
yeah.
do that because we take so much risk. I
Yeah,
mean,
so
it's a huge risk,
Yeah.
but it typically always works out.
Yeah, we do a good evaluation.
Yeah.
And we'll know. Now,
Yeah.
the difference
I know where you're going to go. Yeah.
is if the proceeds have to pay the debt down in order to qualify for the loan
The proceeds you're
from your sale.
I mean, paying the mortgage
They-
down
they
or,
need
or
to
additional
pay.
debt that they have.
they have additional debt.
Yeah, we see that once in a while.
Yeah.
Yeah.
I just had
Right.
one. That's why. I'm
Yeah,
bringing
yeah.
it up.
That was one of
Yeah.
Kathy's.
That's what I'm bringing it up.
Yeah.
So, that narrative is a little different. That we
Right.
may look at that a little differently.
Right.
That hey, because
It's a lot of money moving hands.
well, and it's
Yeah.
happened to us before. Somebody sells a house, and they sold it, and they needed to pay debt down. I know for sure at least 2. And they went out and bought like a Mercedes, and they went out and they didn't pay the debt down, and they ended up buying a car.
right.
And they didn't do what they needed to do to pay the debt down to qualify for the mortgage, and we were left in a really bad spot.
right.
And we don't want to be, not only do we not want to be in a bad spot, but we want to educate you so that you're not in that same bad spot with us because we're mutually together in
Right.
that bad spot.
Yeah.
And when there's nothing we can do, we just, we're getting, I guess, off on a tangent, but
No, it's
definitely
we
worth
see it quite a bit.
talking about,
Yeah,
So,
I mean, if there's nothing we can do and the house is under construction, then it's a bad situation for everybody.
right. And this goes down that whole query of things not to do once you
100%.
sell your home.
Yeah.
Like, please don't do this once you've completed
And-
your
and
mortgage
look,
application.
To that point, we might as well get into that.
Yeah.
Once you guys go under contract, when stuff is going up, please call us. Life comes up. You know, the car got wrecked. I got to get a new car. Okay, just let us know. We prefer greatly no job changes. You don't know what the new pay structure is going to be in your job. If you change from salaried to hourly, it's problematic. Kind of ridiculous, some of it, but really problematic if you were changed from any kind of salary, hourly position to commission. Much more problematic if you go from hourly to salary to 1099. Listen, life happens. I had a company that decided they're going to put all their employees on 1099, during construction. So we had to deal with it, So life happens, but just let us know. No major financial changes that you can avoid until after the house is done, please. Debt being a big one. Watch the car payments changing. If something comes up, please call us and let us know. Once somebody has moved from a W-2 to a 1099, guess what? You're newly self-employed, and you're going to have a tough time qualifying for the loan. So just things of that nature. I had a client that decided to be a woodworker, and he said he had to follow his dreams, and I'm like, well, your dream is building this house that you're in the middle of, and now you don't qualify. Please go back to the post office and get your job back, which he did,
Right. Yeah.
and closed. So.
Also, I think, making sure that they pay their bills, right?
That's a big one.
On
Yes,
time,
yes.
right?
That's a
I
big
mean,
one.
that's something you
Yeah.
can't
I
miss
mean, it
any
sounds
payments,
simple.
right?
Yeah.
You can't miss a payment.
Yeah, one or two, we usually it's going to be okay depending on the loan program,
Right.
but the none is much preferable.
Yeah.
And the reason for this, and just so we can kind of pull it back together, so there's probably an endless list of don'ts. Please don't be late on payments. Please don't quit your job because you've already been you've filled out the application and been qualified based on what you've stated, right? But the reason it's important is what you've touched on in your really sprint in the beginning is there's another underwriting process towards the end, right? So so I think what happens, people think that they got pre-approved. They've done the application.
Once in a blue moon, that's, yeah.
Well, I guarantee you that's the thought process, right? I've already been approved for $400,000. I've filled out the application.
Right.
And now it doesn't matter because I'm already pre-approved. Towards the tail end of this process, right, there's another underwriting step that goes into this, correct?
Re-underwrite. Yeah.
Re-underwrite.
New credit report.
And that happens on 100% of our mortgages.
100%.
Wait, this is though, when we go to a pre-con meeting though, I think even before that, we haven't even gotten to the commitment yet, correct?
Pre-con, you should have official underwriting commitment. So guys out there, you get a pre-approval letter, and then we're going to give you a much better letter from underwriting that says you are conditionally approved for a loan. Based off everything they sent in and the appraisal.
Right. So everything we've been talking about.
Appraisal's been
all
underwritten,
that,
all that good
they've
stuff.
uploaded all their
All
documents.
the problems we talk about didn't happen. This is the best route. You got a nice, solid underwriting conditional approval.
Which then gives us the green light to start construction.
That's
right?
what we talk about on our
It's a
Tuesday.
commitment to lend money.
Right.
Right.
Janet
So
has her ready to draw.
We get that commitment from the lender, from CrossCountry all the time.
And we can provide it to the customer.
And we have a building permit. The lot's ready to go.
We don't track the building
Yeah.
permit. That's
Yeah.
your bag.
Yeah.
Yeah, but
That's our call.
That's
right.
Right. Okay. So we got the commitment. Then we start construction.
Correct.
Yeah.
Yes.
I want to go back to one thing that's very cool that you guys do. A lot of your customers qualify anyway. They're like, no, I don't want a $550,000 mortgage. I want a $400,000 mortgage. I'm going to bring $150,000. I got it. No problem. I'm like, okay. And I'm like, don't bring it to the pre-con. I'm going to approve you for $550,000. If Mitchell sees a commitment letter for $550,000, bring it at the end. Keep your money in your pocket.
Right.
I don't know a lot of builders that are doing that. So it's like well, I guess they probably would, but here's the full, no, maybe not, because you guys are putting a lien on the property and then we're not closing until the end. But regardless, it's a cool way to mitigate your, writing a big check up front for a house that you haven't even seen yet, and then when you get to the end and I say, okay, well, we've got you approved at $550,000 still. Do you want to, let's drop it to $400,000. Let's drop it to 200. Chris, we're going to pay cash. We don't like that all that much.
Yeah.
But we don't mind it either because it's, if you have that ability, great.
No.
If you tell Mitchell Homes you're going to pay cash,
Yeah.
and I can get you approved for a mortgage, we're happy to do it. We'll get you the approval. You got to jump through the hoops, and there's no expense on their part. You guys pay for the appraisal. Right. You're the only referral partner I have that's doing that. Your closing costs really aren't in effect until the closing happens. I'm not sure. I don't think there's any additional expense by doing it the way I'm saying. And then you decide to pay cash, do it that way.
Yeah.
Yeah, we're happy to do it.
Right.
Yeah.
It makes
We're
sense.
not happy to do it, but we'll do it.
Yeah. Yeah.
So
Yeah,
anyway.
that way they're keeping their money, you're getting interest on it, you're investing it, whatever, right? We don't need it until the end because we've got the commitment that there's going to be a loan there. So yeah, that.
And if you decide to bring additional money at the end that you didn't tell us about, but you say, look, I'm going to drive this loan amount down to $200,000. That's fine, and your payment will come down based on the $200,000. You're not going to be stuck with the $455, whatever it was I quoted you before. But even if there's a delay and you close and you say, I didn't really get the cash in time. Okay. Well, you got to close at the $550. Here you go. Here's your mortgage at $550. Mitchell's home, happy they're paid. You've moved into the house. Your new mortgage is intact. You could then do a principal reduction towards the mortgage and have your mortgage payment recast, except for VA. So, but then we'd probably just do a simple refinance if that's what you wanted to do. A little more expensive, but VA refinances are super cheap.
Yeah.
So just a point on pre-cons and money and
Right.
Yeah.
Right, yeah.
And so that,
Yeah.
It's a milestone for our customers to know too, because that's a critical point in the whole progression. So I'm trying to keep the mortgage side and everything else we've talked about in the other podcasts, because those things are running parallel.
Right, like what's happening when.
Right.
Yeah,
And
and
then-
we don't always know as the mortgage guys.
Right.
Yeah.
Like we give you your approval and
Well, we sit in a meeting every Tuesday and we plan, Tucker's in them, we plan when we're going to set the pre-con, and those questions come up. Do they have their loan? Do we have the permit? Is the site prep done? Blah, blah, blah. Can we go forward?
Yep.
So that is a pretty important stopping point or starting point.
Oh, huge milestone.
huge for us.
So that's where that is. But I still want to go back to the question where my curiosity always has me. So they filled out their loan application. We've gotten the full, what'd you call it? Not a pre-approval, but a conditional mortgage.
Commitment letter.
Commitment letter.
Yeah.
And that's at pre-con. We have a loan. We know we have a
Hopefully,
loan.
yes.
Right? So there we are. But they still are giving that, they're still working off the fact that they gave the information to you whenever. And that's where changes seem to be made. It seems to me that changes are made once we start construction, meaning someone quit their job. Someone decided to do this. Someone decided to do that. And it always, the times that it's happened, it seems to me that it's happening once we start or break ground. Thinking that it won't affect the mortgage because they've already feel secured in a mortgage because we started the home. If that makes any sense. And I don't have any data to support that. It's more of a hunch on my part. But I think what I'd like to do is illustrate today. So we've done this, the loan commitment, and we've started your home. After that, what happens? Like, where really does the mortgage get solidified to kind of come back to the don'ts? Don't do this, don't do that, and tie it back into the total mortgage.
Did you?
No, go for
Yeah. So we've addressed this. Janet and I think Scott, part of the title meeting we had.
Right.
So a nice email is saying, hey, you're conditionally approved. And it's spelling out exactly what you just said. However, once the house is done, we don't have to go through the entire process again, but we have to re-verify everything. Here's what we need, please, to the status quo to remain. So we're addressing it as best as possible.
Yeah.
And I haven't seen, knock on wood, a major change in a credit profile for an individual occur recently. So knock on wood, things have been going pretty smooth as far as that's concerned. We do address certain things if we are, for example, you guys made the decision to allow them to close without the sale of their current house. What I've seen more of is, well, we're not quite ready, and we're like, well, wait a minute, have you listed, and I think you're requiring them to be listed.
Yeah.
Yeah.
We
So
do. Yeah.
yeah. So, but that can fall to the wayside.
Right.
And, I've had one recently. Well, I don't think it was one of yours. It wasn't, but I digress. But the person just wasn't ready. And they're like, what do you mean we have to sell our house? And, so that's something that we kind of firmly but nicely say, remember that in order to close for the current transaction, we're going to require the house to be sold.
Mm-hmm.
We don't, as a lender, we don't care if it sells the day of our closing,
Right.
but as a builder, obviously the risk is on you. The other thing that probably needs to be mentioned is you guys are very lenient on an existing structure on the property that
Mm-hmm.
needs to be removed. And it's the same situation.
Mm-hmm.
They don't, you all don't want to move twice. I get it. Or you want the existing structure to remain intact. Sometimes it can, sometimes it can't.
Right.
It's really up to the county and up to the loan program you're doing. There is some leniency that's coming from the lending side on what we call accessory dwelling units, and that could be a topic for a whole snoozer of a podcast. But it's kind of big right now. People want to keep their existing houses on the property. Now, sometimes it's a manufactured home or a double wide or even a single family, a single wide that can be removed. And you're not going to get your CO until it's removed. And that seems to be a pretty big delay. So
Right.
we're saying, hey, remember, we need to, and it's possible. And again, this is something that I assume anybody on this podcast is welcome to call me anytime about anything, but that you could kind of transfer that into what's called a storage unit. It's
Right.
complex, and
That's when you take the kitchen out,
Yep.
right?
kitchen.
Yeah.
It's basically
Kitchen
turning into
out.
a shed.
Yeah.
There's a lot of challenges with that. Actually.
Yeah, I know.
There's a lot of challenges. So it could be conditioned. The mortgage company might make it conditional that
Right.
it has to be removed.
Yeah.
The county can also say,
Yeah.
you don't get an accessory dwelling on
Right.
this house
Right.
or on this lot. You've got to get rid of it, right? So you're going to get some jurisdictional. Either it's going to be from the mortgage side or the jurisdiction.
Right.
Yeah. So they may
Jurisdictions could be very harsh on it. We
Yeah.
had, I'm not going to interrupt, but we had a local county here in Richmond, one of yours, and they were like, look, we're going to keep the house and try to make it an ADU. And the county said 800 square foot maximum on the other house. So
Yeah,
it's just not doable.
Right.
Yeah.
It gets tricky, and there's a lot of
Yeah.
red tape that goes
Yeah.
into that,
Yeah.
and even in some of the rural areas. But the biggest challenge is there's a power issue.
Construction. Yeah. Isn't it construction difficult?
We've done a couple, more than a couple, where folks tear down an existing home, and they want the house exactly where the old home was. So there's a demo issue that goes into that. There's a bunch of that goes into it, and that actually is my preference because I know I have to get the house down before we build it, so it's pretty easy. When you have an accessory dwelling that has primary power run to it, I know this is boring, but it does create a real big problem when you have power to an existing structure that you're maybe living in, and it's a condition of a mortgage that come down prior to us closing on the loan, but you have power there.
Right.
And I've got to de-energize that power, run new power to the old house.
Interesting.
At least a month before we close, if not more.
Right.
And it still puts you in this really strange area because depending on the
I had
season,
no idea.
depending on the season, you're living in a house that doesn't have power.
Yeah. Well, not only that, but your utilities,
That's
your water, your
water,
sewer,
septic.
whatever it is,
Yeah.
septic and well. I mean, it has to be connected. If you're using the same one.
Yeah, it's a challenge, and that's totally
Yeah.
No,
outside of.
but and that is the point of like so many things are, it seems simple, but your side of it, my side of it, like if we sat in each other's chairs for 3 days straight, you'd be like,
would be so smart.
Yeah.
no, you'd be like, I want nothing to do with mortgages again.
we would be so we'd be so smart, but so
well, you'd see it from the other side, like all the T's and dots, all the stuff I have to take care of, and all the stuff you got to take care of.
That's why it all goes back to what we said in the
Right,
beginning.
communication.
Like, well, you guys know the build on your lot.
Yeah.
You know the intricacies of what we go through, and building on your lot is so different. like, having the existing home on the property. That's not something that most builders deal with. We deal with
Or lenders.
We deal with it all the time. Lenders don't typically deal with that. You guys know how to handle it.
Yep.
Right.
Yeah.
So I guess to kind of close the loop, now we're getting close to closing.
Yeah.
What's happening now?
Okay, so as mentioned before, Janet does a very good job of keeping us informed on, usually after your meeting on Tuesday, I think.
Yeah.
We get the list, okay. And the stuff gets moved around. It happens, right? Some has moved up, some has moved back. And we're doing our best based on that list and the closings to take that list and take it to our list and our pipeline and adjust the closing dates, keeping the customer well informed, and then letting them know. You also send a good letter, which I don't know a lot of builders that do that. Like, hey, you're 30 days out. Right. You send that. Oh, what do you call that? I forget.
I forget what it's called, but we send a
You're
letter.
getting a close letter. Yeah,
Yes.
yeah. So contact your renter.
Yeah.
Tell them, and we're reaching out. Yeah, we're reaching out. And at that point, or close to it, you're looking at locking an interest rate. And we can dive right into that. So, rates. I don't have my phone on me. I really want to look at it, but there was
Is that like 30 days before the close, roughly?
Usually a little after that. 30 days is pushing it.
So you're more like 2 weeks.
Yeah, and then we're gonna just in case, we don't want a rate lock expiration.
Okay.
Most locks are 30 days. Some are 45. Some are 60. Those are your most common.
Yeah.
And what that means is your rate is locked in, and then you can close within that 60-day window, 45-day window, and that's the rate you'll have for 30 days.
Well, I can tell you that depends on environment, because 2 years ago or a year and a half ago, they were trying to lock as early as possible with the fear that rates were going up.
Right. Well, it depends on the environment you're
It's
in.
a big, that's a topic we need to get into.
Right. So
what you're referring to is long-term interest rate locks. They're dead. They're incredibly expensive, and they weren't, but they are now, and it would be a colossal waste of money. So
today.
So we are in a downward trajectory for rates. We caught the news.
Yeah, it's
just right before we sat down.
Today was Fed, one of the Fed meeting days, so today rates went down.
God knows probably the most about this.
Quarter basis points. It's a good thing. We're in September of 2025, by the way, but we're in a.
So what was the last drop? Was December 24, I think.
It was prior to the presidential election was the last rate drop, I believe.
Yeah.
It's almost a year.
I don't want to go down that road, but yeah.
Anyway, so 2 weeks out, you go to lock in the rate.
Correct. So let me dive into rates real quick. So the interest rate that you lock in now is when the house is done. You're not gonna, once I give you the conditional commitment, you are not locking your interest rate. We're probably going to qualify you, I don't know, today at like 6.5, just as a qualifying rate. And rates are better than that. We haven't seen rates in the 5s in a long time, low 6s. We've locked some people at 5.5. Not too long ago, we were pushing the 7s and panicking that they were going to go into the 8s. And like we talked about, it couldn't be a better time to build as far as a rate is concerned. And what I mean by that is, you're hedging your bets that rates are going to be lower by the time your construction is done. And like you said, 4 years ago, plenty of not just Mitchell Homes, other builders I had that went under construction. We had all those delays.
Oh yeah.
We couldn't. Windows were hard to find. This stuff you guys would know better than me. Garage doors, right? So there was massive delays, and at the same time, rates were going up and prices were drastically increasing. So, whatever rate I quoted you or qualified you at when you started, it was higher by the time you got done. So that's when we were doing. I think we were actually running some incentives.
We were
to buy a long-term interest rate lock to protect the consumer from rates rising. We're in the opposite environment, and we think there's going to be a flood of buyers. That the rates are going to drive buyers, and then you've got a seller's market, not just for new construction, and that's not exactly ideal if you're a buyer. So the thing that may will probably happen is prices. Well, their prices are going to go up. Prices go up. So, we have clients that are waiting maybe till next summer to see if they could get something in the 4s. Well, by the time you do that, your house is going to be 50 grand more.
Right.
It's very, very, very possible. And I can't. I don't have my calculator. I mean, I can't survive without it. But I could run a payment. Your payment's higher,
Right.
with a lower rate. So, and the advantage you have now of starting with new construction now is that we're going to qualify you at a certain rate. There's a very near certainty that by the time you get to the end, the rate's going to be even lower, and even then, you're probably looking at a refinance. A year and a half, 2 years. We think that the problem's going to be when to pull the trigger on a refinance, not just a refinance. It's like, should I do it now or should I wait for them to drop even further? I hate to go through the full process and they keep going. I mean, who knows, right? I don't have a crystal ball, but based on the news that came out today, it is kind of cemented that we are definitely finally in a rate dropping environment for the foreseeable future. And that's a good thing. So, but back to the timeline, if your house is done, people are very happy right now because they were qualified in the 7s for you guys that we started 7, 8, 9, 10 months ago. If there was a delay, and like, hey, great news, I got you for 5,875. I mean, people were floored. It's great.
Wow.
It's a great feeling. It was a horrible phone call to make.
Yeah.
But
That you have to say, look, he's 7.5, and they're like, what? And some knew.
Yeah.
But rates are dropping. One thing we talked about, that don't follow the Fed like we do. Rates are great.
Yeah.
I mean, they're continuing to slide. Get your maximum that you can, get pre-qualified with us, and then make your decision based on that, I think, and then know that you're in a good environment as far as rates are concerned. Better than I've seen in many years.
Yeah. And
So-
even with rates, I mean,
And we're not going to get back to the 2s, guys. I'm sorry to tell you.
no, it's not going to
That was an
happen.
anomaly.
But even at 7.5, or wherever we are today, let's say it was 6.5, whatever it is, what you said is the most important thing.
Yeah.
Like, it's always better to buy if you want to build.
Yeah.
Especially if you're building, you have land. Like,
Yeah.
you don't want to wait,
But
because even if we're not in a market where they're going down right now, whatever it is, if you get in at 6.5, your price is lower now than it's going to be a year from now.
Yeah.
Even if rates aren't dropping, the price of homes always goes up.
Yep.
Right? So if you wait, the price is going to go up, and you can always refinance.
Yeah.
Whatever it is, if you're paying that payment for 2, 3, 4 years, and then you refinance,
Yeah.
at least you locked in that lower price.
yeah, absolutely.
all right. So 2 weeks out,
We're done.
We locked the rate.
Yeah.
And then at that, so roughly 2 weeks to up until closing day, we locked the rate, or
We lock extended past the closing date for
Okay.
any
protection of
correct.
and then they close. They get their mortgage and all. So all the things we just talked about, trying to kind of put a end time to this. So they've gone through all this. They've done the pre-approval, the pre-qual. They've done the application. The appraisal comes back well. They've done all the things you've asked them to do. You get to the point where you're locking in your rate, and then you close, and then they take. We get paid. They get their mortgage. All is well with the world, right? That's how it's drawn up.
Yep.
That's how it's drawn up. So it's really not like super complicated. We've said a lot of words, but at the end of the day, if you go through and you fill out your application and you get the paperwork that you need, and you don't make any adjustments, and you don't take on more debt for if you don't have to, and you kind of take a 8-month kind of like, we're gonna just kind of keep it steady and not shake things up, you should arrive with the closing without any problems, right?
Yeah. And that rate lock, we're also, a lot of things are occurring at rate lock. We are also communicating with title. We are communicating with the appraiser. We are seeing where we are with the CO. We want to make sure that things are completed that we require.
Right.
So we're at that time of the rate lock, if you want to restructure, and when I usually come down, or if we're over, look, you went over a little bit, but that's okay. We're going to increase your loan amount. A lot of times it's okay, because we are communicating with Janet and with the customer, like, look, this came in higher, so then we if we have to increase the loan amount, if we want to bring it down, we can move within a certain range. and that's locked in, because at rate lock, we want to get the loan exactly the way you want it. You know, we want to, and here's your payment. So that's when it's really finalized. And then we're going to ask for updated documents, you know, mostly just pay stubs, pay stubs, W-2s. And then it's got to go back in underwriting. We want to get that clear close. You know, that's a happy day for us.
Yeah.
And our goal with you guys, and it's been happening, is you know, we want clear closes a week in advance is reasonable. You know, is reasonable. 3 to 4 days is okay. The day of closing's no fun.
No.
We can scramble and make that happen. And there are unforeseen circumstances that still come up, that still come up that we deal with.
Friday at noon's not a good time.
No. But we've done it.
Yeah, we
I got to plug my country. We've got the best closing department in the country. I really believe that. And if I scramble and say, look, I got this thing clear close, I'm sending it to you. It's noon on Friday, and we're closing at 4:00. I get the rolling eyes from my closer, but I'm like, can you crank it out for me?
Nice.
Yeah.
So I'm gonna let you guys go because I feel like I wanted to kind of keep it streamlined on a progression for the homeowner.
Yeah.
But now there's a ton of stuff that I think you guys can talk about and geek out on, and I think that
Loan
you know,
notes.
loan types, like
Right.
closing costs, what a closing costs, how that works. So we could talk about like all the different types of loans, how the interest rate impact the loans. I know I'm curious, like how does credit score affect interest rate?
I'm glad you're here.
You
This
know,
is great.
So I mean,
He knows way more.
I know. Credit
I
scores.
think
What
now
is-
that we've kind of taken, you know, you guys have seen kind of like that progression and what it takes to close. I think now we can go into more nuance and talk a little bit more about the specifics of each type of loan, because I understand it to be kind of like shopping, right? You know, there's going to be something that works for me, VA, FHA, whatever it is. There's going to be different types, and I don't know that stuff at all.
Yeah.
So I think that's an opportunity for you to kind of
Yeah.
tell us a little bit about that.
Before we get into the loan types, I think the biggest question that we get from people is about credit scores.
Okay.
Right? So like tell us about what do you need to have for a credit score to get a loan? If we're just talking like what's the minimum credit score that you guys can work with? Assuming all else is well.
I think FHA we're at 580. I think I can go below that, but you know, here's the deal. Okay, so FHA is when you with your lower scores, you're universally there are some fringe products that aren't FHA, but for anything below really 700, we're probably looking at an FHA loan.
Okay.
Not always, but it definitely when in the lower sixes, we're looking at FHA. Definitely 600 and below. Fannie, Freddie Mac aren't going to touch those. FHA, VA. VA really doesn't even have a score requirement, but here's the deal. If your score is a 550, there's a reason. And that means that VA is probably not going to take your loan because there's something on there that's preventing you from doing that. Same with FHA. So, you know, generally, you know, to be comfortable, you know, we want to get you out of the fives. We want to get you out of the fives. It doesn't mean we can't do an FHA or VA loan in the 500s, high 500s. We've done some for you, but frankly, it's incredibly risky. If I say, look, by the skin of our teeth, we've gotten an approval below 600. You guys are taking. Well, we want to get that up and assure that there's a path for the score to go right.
Do you work with them to help get the score up?
100%. You know, and we have a simulator. It's, in my opinion, it's much better than, you know, going outside to a credit repair agency. They're not a fan, but you know, use us. It's free.
Right.
It's free.
Right.
You know, so you know we're gonna do a very solid credit report, and we're gonna run a simulation, and we're gonna say do X, Y, and Z, and this is what it's predicting your score to, and it's darn accurate.
Right.
It's crazy accurate.
Yeah.
And so they, you know, frankly, customers, I'm like, look, you know, we've got to do this and this and this. And maybe half do it. Come back, say, done, we did it. Okay, great.
Right.
We put it in. It's expensive. We'll take the hit, and the score comes up.
Yeah.
And we can use that new score, and then at that point, hopefully, we're going to fire approval. So yeah, you know, to answer your question, to be comfortable, Govy, that's mortgage speak for FHA and VA, is we want you in the low sixes to be safe, especially on new construction. The risk being, if we have something in the fives and we get you an approval, if we blink, it could flip to something what's called a manual underwrite, and that means that what does that mean? It means a living, breathing underwriter is going to take the risk and put their stamp on it. And there's a lot of qualifications for a manual underwrite, certain reserve requirements. And now we have to have assets. You got a couple months, no lates on this and that. LTV will be limited, so on and so forth. So it's something that can be a little dicey if you're doing new construction. So
Okay.
that's the long story short on that.
Does a lower credit score affect the interest rate?
On convention, yes, it does. I mean, lower scores, you get higher rates. On government loans, it's not as drastic. On conventional, standard Fannie Mae, a massive hit to the interest
What do you
rate.
mean by massive?
The only time I would consider a conventional loan for you guys if there was a ton of lot equity.
Right.
Why would we do that? To avoid the mortgage insurance. And so we could really go down a rabbit hole here. So, FHA has mortgage insurance monthly no matter what your loan to value is. It's a little frustrating. If you got a $200,000 piece of land in your building, yet your score's a 630, I got to give you an FHA loan. You're going to have monthly mortgage insurance for the life of the loan until you can refinance it. Now, if you're like a 680 and you've got a massive amount of lot equity, we may do conventional to avoid the mortgage insurance. And if conventional will take the loan, but there are score adjustments I think they're in 20-point increments going down for conventional that can get nasty. And I mean, 0.5%, 0.75% higher on the interest rate.
Okay.
Yeah.
Okay.
These are fees.
Right.
And they get, unfortunately, not to us. So it's a big fight that they're trying to get rid of those,
Yeah.
the loan pricing adjustments, but we'll see.
Yeah.
We'll see. So, it's the general rule of thumb is, usually your best bet and your best deal below 700 is FHA, regardless of the mortgage insurance. Because the rates are better. The rates are better than conventional, even your stronger conventional. So the mortgage insurance might be worth it. And we're going to do what's ever best for the customer and give them the options as we should. So.
What about VA? You want to tell us a little bit about
it's my favorite loan.
Yeah, I mean we have a lot of retired and active duty military, so it's a big thing for us.
It's
right?
the best loan out there.
Yeah.
It's fantastic. There's no monthly mortgage insurance. The rates are fantastic. Usually if you have any kind of VA disability, you're going to avoid the funding fee. VA has a funding fee that they add on top of the loan. It's tiered. It has a bunch of different tiers.
Right.
I don't have them memorized, but lower loan to values. When I say loan to value, I mean the percentage you're borrowing compared to the value of your property. So if you have a lot of lot value there, you're going to avoid that higher funding fee. Could be quite low. Rates are good. The qualification, the VA is a little, we different programs are stickier than others as far as underwriting qualifications, depending on whatever unique situation there is. But VA is usually pretty darn lenient, and their scores are, credit score is not a tremendous factor. But again, if I have a lower credit score, it may be hard to get through. Everything is run through an automated underwriting system. The whole country uses it. And we want that thing to fire and approve eligible every time. And that's what we're looking for. Sometimes it fires what's called a refer. And that's when I have to do what that called that manual underwriting. So what we're shooting for on all your customers is get that approve eligible. If we've got to get their score up or whatever we may do, we want to see an approve eligible. I will work with Janet and say, look, we are doing a manual underwrite on this, and the customer may have a very good reason why the system is just saying maybe, because that's what refer means, and then an underwriter, a physical underwriter, is looking at it and saying, we'll put my signature on this because that's what she is going to do, or he. So, there's always a way to get the loan done. Not always. I mean, sometimes we get stuff from your clients and, there's major credit stuff going on. There's major credit events that have occurred relatively recently. And we're not going to just push them away, but they may be a year out. And maybe look, let's stay on the path. Let's get your credit healthy. Get this buried. The thing with credit is, if it occurs, it occurs. And a lot of times we hear from clients who are like, "Well, I paid it off." Well, right, yeah, that's good, but it still happened. It still was a default. And if a car mortgage default has depending on the program, the govies are much less of a timeline from when the foreclosure occurred than conventional. But we could be close on that timeline, and we could be kind of make a decision that say, look, by the time the house is done, we've got that thing buried 7 years. It's going to drop off. Who knows? We see all kinds of situations. Co-signed a car for a child or vice versa, and that went in default, and who knows? We're not going to just say no and not call them back. Right. One of the coolest things, I'm sorry, is people, their credit scores drop when they max their credit cards out, and it's the simplest way to get your scores to drop back. We're like, look, pay your credit cards down. Right. I don't know, 50%. Whatever the simulator tells us. They pay the cards down. 50 scored point jump. It's amazing. Now, conversely, major credit event, a default, or some kind of thing like this. Yeah. This is where we really get boring. It's we're talking about credit, but it unfortunately that the only thing that may cure that is time.
So you meet with the customer, you're going over the credit score. Do you help them shop the mortgage all the different mortgages that you just
we have to
talked about?
We're never
sit
gonna
with them and speak with them about what makes the most sense, and kind of almost like financially plan their mortgage and help them understand what the best program is for them, right?
Yeah, and back to VA. I mean, usually if they're a vet, I'm like, oh no, go VA. But of course, if they don't want to, if they want to look at conventional, VA can be tricky if you already have a VA loan. FHA can be very tricky if you already have an FHA loan. Generally, you can't have two. It's not entirely true. There is an exception to have two, but they're hard, and you got to qualify carrying both of them mortgages. Now, VA will allow you to have two, but you may have an entitlement issue where we have to run your entitlement to see what's the maximum amount of VA loan we can give you because you've already used some of the entitlement. Gotcha. Right. You may have perfect credit, but have an entitlement blip from the 80s, and we got to dig in and see what happened. Something weird happened to you in the 80s, and it screwed up your entitlement. We'll work with the customer to help them restore their entitlement. There's not a lot we can do, but it's more about them doing the paperwork with the VA. Right. But VA is a killer program. And I want to segue with that into one thing we skipped is, what if you don't own land? Right. I mean, it's out there. Yeah. And we can still do it. The Simply Mitchell is killer. It really is. Using lot equity, Mitchell has essentially become the construction lender for your transaction. It is similar to a construction to perm loan that's a 2-time close with no cost, with no payment on the. You are right when you're saying that.
Yeah, no.
Okay.
Of course, yeah.
Mitchell Homes is not a lender.
I love it.
No. I got muted out. Disclaimer like 18. But they're not. They're not. There's no payment. There's no repayment. I know you vetted this, but there's a lien that's placed on the property, and then we pay the lien off through a refinance. Technically, it's kind of a hybrid loan. I mean, but it is a refinance, which are cheaper. Refinances are always cheaper closing cost wise, transfer taxes, so on and so forth. And Mitchell carries the interest, carries everything, and we simply pay off Mitchell Homes like we're paying off a mortgage that already existed on your property. Right. There's no difference. And it's cool. However, if you don't own land, we have products out that will allow you to acquire land with a low down payment. And what I have, we call it the land home package. It's a modified kind of construction perm for Mitchell Homes. Technically, it is a one-time construction perm loan, but it's very different with Mitchell Homes. Mitchell Homes does not care if you get a construction loan or not, but we can use one to cheaply allow you to acquire land.
Right. Yeah.
And
Yeah.
Did you want to jump in on this?
Just real quick. Yeah. And, that's we'll use them occasionally, but the same rules still apply as far as our advantages, because we're not taking draws on the construction money. So there's no construction loan interest on the home.
Right. And that's what I was getting to. It's like, the only builder I have that will, if I do a construction to perm to allow the customer to acquire the land, allow you to acquire the land, it's really a line of credit that, let's just say your house is let's say 400, land's 100. We put those two together, you're at 500,000. We give you a line of credit for $500,000, but the only thing that's drawn out is $100,000. So you're going to pay interest on that 100,000, and we even could roll that interest in and do what's called an interest reserve, so that you have no interest payments during construction. It's very cool.
Yeah.
And on VA, we can do it at 100% financing. So if you're a vet and you want to find land, we got you.
That's
cool.
cool.
You can buy land with no money down.
That's really cool.
Yeah, and build a house. So we've done a ton of them. We've done quite a few for you guys and others around the country.
So, and that works also if they do have land, but they have a lot payoff.
Sometimes. So if they have land and they have a lot payoff, we can still usually do Simply Mitchell.
Right.
Now, on occasion, and now we get really complicated, I may have to do the construction to perm if you've got a tear down situation with a mortgage.
Right.
So that gets a little funky.
Right.
And then that's hard to do as a refinance. So the Simply Mitchell, even though it still applies to the construction loan, the standard Simply Mitchell, where there's a mortgage already on the property, can't come in and put another lien on the property. Well, they can, but then I can't pay off both.
It has to be paid off.
It has to be paid off.
Right.
And hence the construction loan will wipe that out. So if you got a tear down that you found, to one of your podcasts was really, really cool, seriously, about looking for land, and you find one that has a house that you're not interested in, but you want the land and you want to tear the house down, but you go and you may buy it or you inherit it, whatever it may be, and there's an existing mortgage on the property. It's very difficult to do the Simply Mitchell financing that way, but we can come in, you can tear that down, and we can pay off, as long as we've got the appraisal and all the other things that are, and I only need a 620 score for that, which is the strongest in the industry.
Wow.
We can pay it off and give you just a loan. The line of credit would still apply, but at the $100,000, assuming that's what it would be paid off, and you'd be able to build. And that's a big snag a lot of people do. And thinking about your podcast, we have one in North Carolina, not one of yours. It's really cool. The fire department did a controlled burn, free. Yeah. So I don't know if there was any. You sound like you've seen that.
Yeah. I mean, the fire departments will work with, if they need training.
Yeah.
That's what it was.
They'll do training. The local fire departments will do training if you need a controlled burn. I mean, there's a lot of different ways. I still think
you guys still have to come in and clean that up, or
but I mean, if you let it burn and you take everything out, and you're not putting it where the house is, fill it with dirt and move on.
Mm-hmm. Cool.
But I do think that I'll stand by this. I think some of the better values out there are pieces of property that have existing structures on them. And if you're just going to buy property and you don't already have it, and it's a double wide or single wide or something like that, they can come down pretty easily. I think that's overlooked so often because there's something already on there. What an advantage though if you have power's already there, a road's already there. A septic and well typically are already there.
Yep.
I mean, and you could pick it up for a song, and all you got to do is,
I'd love to do that.
The fire department
personally.
Have them set the trailer on fire.
Don't do it yourself.
That's great.
Yeah, right. Don't do it yourself. But that's great.
I didn't realize that can affect the loan, but that makes sense.
Yeah, it's a little bit of an argument fight
but
with
it's
underwriting.
still, I mean, we can do it.
Yeah.
We still are not going to charge, there's not going to be any construction loan interest on the home itself, and we're still going to pay the closing costs. So it's basically, you're still getting,
and you don't have to make a payment. So if you went and got a lot loan, you're making a payment monthly. We can mitigate that as well.
Yeah.
Yeah.
That makes sense.
Yeah, it's cool.
Yeah.
Well,
now, it might make sense to a lot loan would be like, look, you're putting $50,000 down, or you just pay cash for the land.
Right.
Rock and roll. Move forward. Right.
Yeah.
We're just going to simple minutes.
Right. It's great.
Yeah.
So
we're going to do whatever's best. We're not going to push into that program.
Right.
Yeah.
Let's talk a little bit about just closing costs, just so people sometimes don't really understand, what are closing costs, what's included in closing costs, and what is the difference between closing costs and prepaids.
Okay. So most mortgages, We'll start with prepaids. You're going to have an escrow account to pay your taxes and insurance mostly. Sometimes some other things are in there, but that's the majority of it. It can be expensive, it depends on where you're building,
Right.
in the cost of your house. And during new construction, it's tough because we're doing a best guess on what your tax assessment's going to be. And usually we're just going on the appraisal, and because the county hasn't assessed anything yet, I wouldn't think. So we want to set up an escrow account. You can't just start with zero. So your first payment can't just have your taxes and insurance divided by 12, because then whenever you close, if your taxes are due the next month, you're going to be short, and that's not pleasant. That's called an escrow shortage. You don't want that. So then there has to be made up. So we're going to calculate that depending on your county and your homeowner's insurance, whatever that premium it may be, and we're going to put those into your escrow account. We're going to set up a prepaid account, just like Scott said, that is could be several $1,000s to $5,000-$6,000 that are going to be set aside. It's your money, but it's set aside to pay your future taxes and insurance. So that is not something that's going to be covered through Mitchell's agreement to pay closing costs, because it technically is not, little semantics, but that's not a closing cost that's agreed upon in the contract.
Right.
So the other cost involved, there's lender costs. We have an underwriting and processing fee. That's it usually. There's the appraisal. Mitchell pays for that up front. That's huge. Most of my other transactions, we have to ask you for a credit card. When those plans and specs came in, we asked you guys for a credit card. I figured we have it on file, actually.
Yeah.
So sure, cool. So I didn't know if you knew that. But and then you have title costs. You have title insurance. Usually we advise carrying 2 versions of title insurance, both lender, which is required, and owners. They're usually about the same. The owners is a little less. Owners will protect you if you got an inherited property or anything of that nature. So there's that. Plus this kind of standard title costs that are very vanilla.
Right.
You could shop it around. You're going to find the same thing. Mitchell has a preferred title company for the exact same reason they have a preferred lender.
Right.
Because they have seen it all. But those costs are in there. And then you have transfer taxes. And as we discussed, since these are structured refinances, most of the time, not always, those transfer taxes can be much less than if you were going to buy a comparable resale, or if you were buying an existing new construction, you're going to have a significantly more transfer taxes.
Right.
That's another advantage of the Simply Mitchell. So now, based on all that, what Mitchell pays is a healthy portion of most of that. I think it's a percentage usually we try to use. I rely on Janet to let me know what it's going to be. It's a little tricky because you're going to see those closing costs, and they have to be disclosed because they are a cost. So they're going to be on your loan estimate. They're going to be on your closing disclosure. But for Mitchell to pay them, since they just have a payoff, they are going to subtract it out of the payoff.
Correct.
Right. So you can get that documentation from Mitchell where they say, okay, well, look, you owe us $390,000. But we're going to make it $385 or something like that.
Right.
So that's how those closing costs are paid. And it's, it's just where the number of balances out, and there's just nowhere to put seller credit on there because there's no seller.
Yeah.
You guys are not a seller. So, but you take it off your payoff, which is the same thing.
That's right. Yeah.
Right. So it's really cool. Very cool. And it's like, hey, you're $5,000 short. Oh, no, never mind. You're not.
Right.
So it's like really nice.
Yeah.
So,
Okay.
yeah.
Cool. What else you got?
Louder.
I have no more questions.
I know.
I think that I've
Do you,
gone past my
You ready to take your
capability
test?
of no. What I know about mortgages, which isn't a ton, I think that hopefully you guys got a lot out of this. I mean,
it's a lot of information, and I talk really fast. I do, but please call me. And everybody is unique. Just that's what we're here for. Call me, text me.
Yeah, we've got your information, I believe, on our website. We should have our lending partners on the website.
Yeah, it might be like Kathy and Liz.
Yeah.
Yeah, just so the the general public knows, like I said, we have a team that works on Mitchell Homes. We need a team because of our partnership with them, and we want the service to be great. So someone named Liz Copeland covers. Help me, I'm gonna get this wrong, but she covers Hampton Park and Fredericksburg, and then Kathy Rossi covers Richmond, any of the salespeople in the Richmond office, not just those areas, and Raleigh.
Right.
There's the two offices for now.
Liz is Hampton Roads, Virginia Beach, all that area.
Yes,
correct?
yes. So whatever flows through the
Newport News.
thank you.
Newport News
I said wrong.
office.
That's what I was saying.
Yeah.
So the Newport News office,
Yeah.
Liz handles as well as Fredericksburg, and then exciting stuff with the Wilmington. That is so cool.
Wilmington
Yeah,
coming soon.
when is it opening? I want to go down there right now.
Wow.
I love Wilmington.
Yeah.
Seriously.
It won't be long. It won't be long.
Like when?
We-
I think it was on a podcast, wasn't it?
Yeah, we keep saying it, and I'm jinxing myself, so I've decided I'm not going to mention it anymore until we know for sure.
Well,
I said it last. I said it on the last podcast, and I was like,
yeah.
trying to hem and haw over it.
They staked it out.
Yep,
I even Googled Earth where it was going to be.
Yeah, it's a
Let's
great
go right near the
location.
battleship. I mean,
It's cool.
you're gonna see it going over the bridge.
Yeah.
I love
Yeah,
Wilmington.
Yeah, it's right at
I just
over the bridge.
visited Wilmington for a college visit for my daughter, so it's
We should have the permit this next week. But
Yeah.
this is what's the September 17th.
Yeah, but we're already selling there. So we're selling.
Yeah, I
we're
didn't-
building. We've built several down there.
we have
yeah.
under contract, so it's good.
Yeah.
good.
No, exciting times.
Yeah.
Exciting times.
Yeah.
Yeah, very exciting.
Yeah, I think that hopefully you guys got a bunch out of this, and I think this is a lot. Like most of our podcasts are a lot.
Yes.
The wells and septics. It's a ton of information.
Yep.
But like we always say, watch it a couple times. If there's something that we didn't cover, write it down.
Right.
Put it in the comments. Let us know where we may have inadvertently not touched on something that
Right.
you
Yeah,
really
it's very
wanted to
possible.
know.
Yeah, this is a lot of information. It's very, very
yeah.
technical. I think you did a great job.
Thank
and,
you.
We appreciate you being here.
I really appreciate being here.
And yeah, definitely ask us questions in the comments because that's how we know like what information to provide you guys. And we've been getting some good comments.
Yeah.
Can I see the comments?
Yeah, we'll send them to you.
Oh, I can't see them.
Oh no, you can see them. Yeah,
They're like public. Yeah.
They're there for the public.
alright.
Yeah. So
He's dying
Yeah.
to know what people say about him on the podcast.
Come
yeah,
on.
tell him
not
how he
true.
looks, how you like
It's
his
true.
t-shirt. He's got his cross. That's a cool. I want one of those t-shirts.
You got it.
It's
Done.
not a Mitchell Homies t-shirt.
No,
I-
we're gonna have to
I
get
don't
you.
have it.
We'll have to get you a Mitchell Homie t-shirt.
Oh, it literally says homie.
A Mitchell Homie.
Oh, Mitchell homie. Okay.
Okay, yeah, that's the,
I like it.
that's the- anyway,
right.
I have the
think
hat
for
too, by
me,
the way.
I'm good. Thank you, Chris, for coming.
Thanks for having
and
me.
enjoying
Yeah, that
us
was-
and
yeah.
comment away.
Yeah,
right.
Thanks,
great.
guys.
Thank you. See
Yeah.
you next time.
See you next time, gang.
See ya.
Ciao.